In the spring of 2002, deep inside the finance department of the second-largest long-distance company in America, an internal auditor stayed late at her desk. She wasn't supposed to be looking where she was looking. Her name was Cynthia Cooper, and her small internal audit team had started quietly pulling on a single accounting thread, a line item that didn't behave the way an ordinary expense should. According to her later testimony and her own account, what began as a routine review turned into a search her own bosses had told her to drop. Within weeks, that thread would unravel roughly $11 billion in fake profits, collapse a company with tens of thousands of employees, and help send its celebrated CEO to federal prison. This is the story of WorldCom, a telecom giant built on real ambition and, prosecutors said, propped up by numbers that were not real at all. To understand the fraud, you have to understand how improbable the company was in the first place. WorldCom's roots trace to a small Mississippi long-distance reseller founded in the early 1980s called LDDs, Long Distance Discount Services. Its most important early backer and, from 1985, its chief executive was Bernie Ebbers. Ebbers did not look like a telecom titan. Before business, he had worked as a milk deliveryman, a bar bouncer, and a motel operator. He was tall, bearded, plain-spoken, and, by most contemporary accounts, relentless. Over roughly a decade and a half, Ebbers turned that small reseller into a global carrier, not mainly by building networks, but by buying them. The growth came through acquisitions, dozens of them, one after another. The company renamed itself WorldCom in the mid-1990s. Then, in 1998, it stunned Wall Street by swallowing a company several times its size, MCI Communications, in a deal valued at roughly $40 billion. For a time, the ambition seemed limitless. In 2000, WorldCom and Sprint announced plans to merge in a deal worth well over $100 billion, a combination that would have reshaped American telecommunications. But regulators in the United States and Europe blocked it, citing competition concerns. And that, in hindsight, is where the story turns. WorldCom was a company whose entire identity was built on the next big deal. And the deals had stopped because here was the underlying problem. WorldCom's stock was its currency. It used its high share price to fund acquisitions. To keep the stock high, the company had to keep hitting the earnings targets Wall Street expected. And beneath the surface, the core business, long-distance telephone service, was under enormous pressure. Prices were falling. Competition was fierce. The engine that was supposed to produce those profits was sputtering. At the center of it all sat Ebbers, the deal maker, and his chief financial officer, Scott Sullivan, a young, highly regarded finance executive who was, for years, one of the most admired CFOs in the industry. So how do you make a struggling company look like a thriving one? According to the SEC's complaints and the criminal case that followed, WorldCom did it in two main ways. The first involved a category of cost the company called line costs. Line costs were the fees WorldCom paid other carriers to use their networks, to actually route customers' calls. They were unambiguously an operating expense, a cost of doing business that quarter. Prosecutors and regulators said that beginning in 2001, senior executives ordered those expenses reclassified, moved off the expense line, and recorded instead as capital expenditures, as if the company were building long-lived assets. That single accounting move is deceptively powerful. An operating expense hits your profits immediately, in full. A capital expenditure gets spread out over years. So, by relabeling billions of dollars of ordinary costs as investments, WorldCom could make expenses seem to vanish from the current quarter and turn losses into the profits Wall Street was waiting for. The SEC would later state that the company improperly capitalized roughly $3.8 billion in line costs across 2001 and early 2002. That was only the first mechanism. The second involved reserves. When a company acquires other businesses, as WorldCom had done over and over, it sets aside reserve accounts to cover expected future liabilities. Prosecutors alleged that WorldCom raided those reserves, releasing them to offset expenses and pad reported income when the real numbers fell short. Indictments in the case charged that reserve accounts were drawn down specifically to create credits against line costs. Added together, the reclassified expenses and the manipulated reserves formed the core of what investigators ultimately described as a fraud totaling around $11 billion. Now, an important distinction the record insists on. Much of the mechanical work, the journal entries themselves, was carried out lower down by accountants in the General Accounting Department. Several of them, including Betty Vinson and Troy Normand, later pleaded guilty and testified that they made entries they knew were wrong, under pressure from superiors, fearing for their jobs. According to trial testimony, the instruction to hit the targets came from the top of the finance organization. The question that would define the biggest trial in the case was a simple one. How much did the man at the very top, Bernie Ebbers, actually know? The fraud did not come apart because a regulator caught it. It came apart from the inside. In early 2002, Cynthia Cooper, WorldCom's Vice President of Internal Audit, and her team, including auditors Gene Morse and Glyn Smith, began examining capital expenditure accounts that didn't add up. By her account, when she raised questions, Sullivan personally told her to hold off. She didn't. Working nights, sometimes reviewing records quietly to avoid drawing attention, the team traced hundreds of millions and then billions of dollars in entries that had no legitimate support. Ordinary expenses dressed up as capital assets. In June 2002, Cooper took her findings to the Audit Committee of WorldCom's board. The internal review confirmed the scale of the problem. On June 25, 2002, WorldCom publicly announced that it had improperly accounted for roughly $3.8 billion in expenses and that it would have to restate its earnings. Scott Sullivan was fired. David Myers, the controller, resigned. The next day, the Securities and Exchange Commission filed civil fraud charges against the company. For investors who had trusted WorldCom's books, the ground simply gave way. Less than a month later, on July 21, 2002, WorldCom filed for Chapter 11 bankruptcy protection. With around $107 billion in assets, it was, at the time, the largest corporate bankruptcy in United States history, larger even than Enron, which had collapsed only months earlier. Tens of thousands of employees would lose their jobs, shareholders were wiped out, and Cynthia Cooper, the auditor who refused to look away, would be named, along with two other whistleblowers, one of Time magazine's Persons of the Year for 2002. The legal reckoning fell hardest on the two men at the top, and it fell very differently. Scott Sullivan, the former CFO, pleaded guilty and agreed to cooperate. At Bernie Ebbers' trial in early 2005, Sullivan was the government's central witness. He testified that Ebbers had pressured him to deliver the numbers Wall Street expected, that, in Sullivan's account, Ebbers told him to hit the numbers. Ebbers' defense argued the opposite, that Ebbers, a salesman by temperament, left the accounting to Sullivan and did not know the books were false. Ebbers took the stand in his own defense and denied knowledge of the fraud. The jury did not believe him. On March 15, 2005, Bernie Ebbers was convicted on 9 counts, 1 count of conspiracy, 1 count of securities fraud, and 7 counts of filing false statements with regulators. On July 13, 2005, U.S. District Judge Barbara Jones sentenced him to 25 years in federal prison. That same day, the SEC filed its civil action. Ebbers settled without admitting or denying the allegations, accepting a permanent bar from serving as an officer or director of a public company and agreeing to surrender substantially all of his assets, reported to be worth as much as $45 million for the benefit of defrauded investors. Sullivan, whose cooperation the judge credited, was sentenced to 5 years. The controller, David Myers, received a year and a day. Betty Vinson received 5 months in prison and 5 months of house arrest. Other accounting staff received probation or short terms. The gap between the 25-year sentence at the top and the months at the bottom was, the court signaled, a measure of responsibility. It's worth being precise about what this case was and wasn't. The mechanics were almost mundane. No offshore islands, no exotic instruments. It was, at its heart, expenses moved into the wrong column, quarter after quarter, to manufacture the appearance of growth. That's what made it so alarming. If a company this large could hide billions with a basic reclassification, what did that say about how thinly the numbers were being watched? WorldCom landed on Washington at the exact moment Enron's collapse was still raw. Together, the two scandals produced one of the most consequential corporate reform laws in modern American history, the Sarbanes-Oxley Act, signed into law on July 30, 2002. It forced chief executives and chief financial officers to personally certify their company's financial statements, strengthened internal control requirements, and created new oversight of the auditors themselves. The company survived, in a form. WorldCom emerged from bankruptcy as MCI, and in 2006 was absorbed by Verizon. Ebbers was released from prison in December 2019 on compassionate grounds, in failing health, and died weeks later in February 2020. WorldCom is remembered as a story about a dealmaker who ran out of deals, and about the accountants who filled the gap with a pen. But it's just as much a story about one auditor who was told to stop looking and didn't. If this kind of deep dive is what you're here for, subscribe and I'll see you on the next case. Next time, another empire, another set of books that didn't add up. Until then, follow the money.